Welcome to Episode 3 of Nova Bourse US. Today, we are focusing on the foundational architecture of your portfolio, the brokerage account, the 401k, the traditional IRA, and the Roth IRA. If you think the stocks you pick are the most important part of your investing journey, think again. The container you choose to hold your investments is the single biggest factor in your long-term success. Over the next 24 slides, we will break down why your choice of account matters more than the assets themselves. We will cover the specific IRS rules for 2026, explain the mechanics of each account, and provide you with a clear roadmap to help you build your financial future starting from zero. Before you buy a single share of stock, bond, or exchange-traded fund, you have to answer one critical question: what container will hold your investments? Every account, from your taxable brokerage to your retirement plans, wraps your assets in a different tax treatment. If you hold the same S&P 500 index fund for 30 years, your final after-tax wealth will vary wildly depending solely on the account you chose. Taxes should never be an afterthought in your financial planning. They are the very first filter you must apply to your strategy. This episode will explain exactly how these accounts work, what the IRS allows for the 2026 tax year, and how to select the right tool for your unique situation. Let us look at two colleagues, Alex and Jordan. Both are 30 years old, both earn $80,000 per year, and both invest $500 every month into the exact same total market index fund, which averages an 8% annual return. Alex chooses to use only a standard taxable brokerage account. Jordan, however, decides to split those contributions between a 401k to capture an employer match and a Roth IRA. After 30 years, Jordan ends up with roughly $180,000 more in spendable after-tax wealth than Alex. Notice that Jordan did not pick better stocks or time the market. Jordan simply chose better accounts. By the end of this episode, you will know exactly how to be Jordan. A taxable brokerage account is the most flexible vehicle available to any investor in the United States. You can deposit any amount of money at any time, withdraw your funds without worrying about age restrictions, and hold virtually any asset class, including individual stocks, bonds, mutual funds, and options. There are no contribution limits, no required distributions, and no penalties for early withdrawal. However, this total freedom comes with a significant trade-off. Every dividend payment, interest payment, and realized capital gain is potentially taxable in the year it occurs. The IRS views this account as ordinary income territory. There is no tax shelter and no deferral, just an annual tax bill on your investment gains. Inside a taxable brokerage account, the length of time you hold an investment determines your tax rate. If you sell a stock within 1 year of buying it, your profit is considered a short-term capital gain. This is taxed at your ordinary income tax rate, which can reach as high as 37% at the federal level. If you hold that same stock for at least 1 year and 1 day, it becomes a long-term capital gain. This qualifies you for preferential tax rates of 0, 15, or 20%, depending on your total income. This simple timing distinction can either slash your federal tax bill in half or potentially eliminate it entirely, making your holding period a vital part of your tax strategy. For the 2026 tax year, the IRS uses 3 specific long-term capital gains brackets based on your taxable income. Single filers pay 0% on taxable income up to $49,450, while married couples filing jointly pay 0% on income up to $98,900. The 15% rate applies to singles making between $49,451 and $545,500, and to joint filers between $98,901 and $613,700. The 20% rate hits those above these thresholds. High-income households may also owe an additional 3.8% net investment income tax, an intentional discount built into the tax code. Taxable brokerage accounts offer one powerful tool that retirement accounts lack: tax loss harvesting. If you sell an investment at a loss, you can use that loss to offset an unlimited amount of capital gains realized in the same year. If your losses end up being greater than your gains, you can deduct up to $3,000 of that excess against your ordinary income annually, or $1,500 if you're married filing separately. Any remaining loss can be carried forward to future years indefinitely. Just remember the IRS wash sale rule. You cannot claim a loss if you buy the same or a substantially identical security within 30 days before or after the sale, even if that purchase happens inside an IRA or 401k. A 401k is an employer-sponsored plan that lets you contribute a portion of your salary before taxes are taken out. These pre-tax contributions lower your current taxable income. For example, if you earn $80,000 and put $10,000 into a traditional 401k, the IRS taxes you as if you only earned $70,000. Your money grows tax-deferred, meaning you pay nothing on capital gains, dividends, or interest while the cash stays in the account. You only pay taxes when you withdraw the money in retirement, at which point it is taxed as ordinary income. Many employers also offer a Roth 401k option, where you use after-tax dollars today for completely tax-free withdrawals when you finally retire. The employer match is the most valuable feature of most 401k plans, representing an instant return on your money that most people leave on the table. A common formula is 50 cents on the dollar up to 6% of your salary. If you earn $80,000 and contribute 6%, or $4,800, your employer adds $2,400 to your account. Some major companies have historically offered a dollar-for-dollar match up to a specific cap. This is an immediate 50 to 100% return before any market growth even happens. Yet, nearly 20% of eligible employees fail to contribute enough to get their full match, essentially walking away from free guaranteed money. Employer matching dollars often come with a vesting schedule, which dictates when that money truly becomes yours. Under immediate vesting, you own those employer contributions the moment they land in your account, though this is rare. With cliff vesting, you own 0% of the match until you hit a specific service milestone, which the IRS caps at 3 years for 401k plans. Once you hit that cliff, you own 100%. Graded vesting means you gain ownership incrementally, such as 20% per year over 5 years. If you quit your job before you are fully vested, you forfeit any unvested employer contributions. Note that your own personal contributions are always 100% yours, regardless of your company's policy. For the 2026 tax year, the IRS allows employees to defer up to $24,500 of their salary into a 401k, 403b, or governmental 457 plan. If you are 50 or older, you can add an extra $8,000 in catch-up contributions, for a total of $32,500. Under the Secure 2.0 Act, workers aged 60 through 63 qualify for a special super catch-up of $11,250, bringing their total to $35,750. The combined limit for employee and employer contributions is $72,000 or $80,000 if you're 50 or older. These limits are separate from your IRA limits, allowing you to maximize both simultaneously. A traditional IRA is an individual retirement account that you open and manage yourself, entirely independent of an employer. Like a traditional 401k, your contributions may be tax-deductible and your investments grow tax-deferred. The massive advantage here is investment flexibility. You are not limited to the menu of funds provided by your employer, but can choose from almost any stock, bond, or ETF available through your custodian. Whether your contribution is tax-deductible depends on your income and your access to a workplace plan. If neither you nor your spouse has a workplace retirement plan, your contribution is fully deductible regardless of how much you earn, which is a massive, often overlooked benefit for freelancers and small business employees. If you or your spouse are covered by a workplace plan like a 401k, the IRS applies income limits that phase out your ability to deduct traditional IRA contributions. For 2026, if you are a single filer with a workplace plan, the deduction phases out between $81,000 and $91,000 of modified adjusted gross income. For married couples filing jointly where the contributing spouse has a workplace plan, the range is $129,000 to $149,000. If you're not covered by a workplace plan but your spouse is, the range is $242,000 to $252,000. Above these levels, you can still contribute, but you get no upfront tax deduction, often making a Roth IRA superior. For the 2026 tax year, the annual contribution limit for both traditional and Roth IRAs is $7,500, which is a $500 increase from the previous year. If you're 50 or older, You can add an extra $1,100 in catch-up contributions for a total of $8,600. This limit is the combined total for all your IRAs. You cannot put $7,500 into each type in a single year. You have until the federal tax filing deadline, typically April 15th, to make contributions for the previous tax year. Additionally, if you are married, a non-working spouse can contribute to their own account through a spousal IRA, provided you have sufficient earned income. The Roth IRA flips the tax logic of the traditional IRA on its head. You contribute after-tax dollars today, and in exchange, every qualified withdrawal in retirement is completely tax-free, including all the growth. If you contribute $7,500 annually for 30 years and your account grows to $900,000, you will owe zero federal income tax on that massive gain when you withdraw it. Furthermore, Roth IRAs have no required minimum distributions during your lifetime, meaning your money can compound for as long as you live. This makes the Roth IRA an incredibly powerful tool for long-term wealth building and estate planning, especially for younger investors who have decades of tax-free growth ahead of them. The IRS restricts direct Roth IRA contributions based on your modified adjusted gross income. For 2026, single filers earning below $153,000 can contribute the full $7,500. Between $153,000 and $168,000, the limit phases out, and above $168,000 you cannot contribute directly at all. For married couples filing jointly, the full contribution is available below $242,000, phasing out completely at $252,000. For married individuals filing separately who live with their spouse, the limit is extremely restrictive, phasing out between $0 and $10,000. For high earners, we will soon discuss the backdoor Roth strategy to bypass these limits. To take a fully qualified tax-free distribution from your Roth IRA, you must satisfy two rules. First, you must be at least 59.5 years old, disabled, or using up to $10,000 for a first-time home purchase. Second, you must have made your first Roth IRA contribution at least 5 tax years prior. The clock starts on January 1st of the tax year, for which you made that first contribution, even if you actually deposited the money the following April. For instance, if you fund your first Roth IRA in April 2026 for the 2025 tax year, your 5-year clock started on January 1st, 2025, and will expire on January 1st, 2030. Each conversion has its own separate 5-year clock. The IRS has a very investor-friendly rule for Roth IRA withdrawals: the order of distributions. When you take money out, the IRS assumes you are withdrawing your original after-tax contributions first. You can pull this principal out at any time, at any age, for any reason, with no taxes and no penalties. Only after you have exhausted your total contributions does the IRS count withdrawals as coming from conversions, and only after those are gone do you touch your earnings. This means your Roth IRA acts as an emergency fund. If you have contributed $50,000 over the years, you can withdraw that $50,000 whenever you need it, tax-free and penalty-free, provided you do not touch the investment growth. If you withdraw from a traditional IRA or 401k before age 59 and a half, you generally face a 10% penalty plus ordinary income tax. However, there are important exceptions. You can avoid the penalty for up to $10,000 for a first-time home purchase, qualified higher education expenses, or unreimbursed medical expenses that exceed 7.5% of your adjusted gross income. Other exceptions include health insurance premiums during unemployment, birth or adoption costs up to $5,000, and distributions under IRS Rule 72(t). Secure 2.0 also allows for penalty-free emergency withdrawals of up to $1,000 per year and up to $10,000 for victims of domestic abuse. Remember, Roth contributions are always penalty-free. Required minimum distributions, or RMDs, are the IRS's way of ensuring they eventually collect the taxes you deferred. Starting at age 73 or age 75, if you were born in 1960 or later, you must withdraw a minimum amount annually from your pre-tax accounts like traditional IRAs and 401ks. This amount is calculated by dividing your prior year-end balance by an IRS life expectancy factor. For example, at age 73, the factor is 26.5. meaning a $500,000 balance requires an RMD of roughly $18,868. Missing this withdrawal triggers a 25% penalty on the amount not taken. Roth IRAs have no RMDs for the original owner, which is a major advantage for wealth preservation. The backdoor Roth is a legal strategy for high earners to fund a Roth IRA despite income limits. The process is two steps. First, you make a non-deductible after-tax contribution to a traditional IRA. Second, you convert that balance to a Roth IRA. Since there is no income limit on conversions, this is fully legal. However, you must watch out for the pro rata rule. The IRS looks at all your traditional, SEP, and simple IRA balances combined. If you have existing pre-tax IRA funds, a portion of your conversion will be taxable. The cleanest way to do this is to have zero existing pre-tax IRA balances, perhaps by rolling old IRA money into your current employer's 401k plan before starting the backdoor process. Every investor operates within a three-bucket system. Bucket 1 is your taxable brokerage account, which offers liquidity and tax loss harvesting but suffers from annual tax drag. Bucket 2 is your tax-deferred 401k and traditional IRA, which gives you an upfront tax deduction but forces you to pay ordinary income tax on every dollar during retirement, along with RMDs. Bucket 3 is your tax-free Roth IRA and Roth 401k, which provides no upfront deduction but delivers completely tax-free growth and no RMDs for Roth IRAs. The most resilient retirement plans do not rely on just one bucket. They build assets across all three, giving you the optionality to manage your tax brackets, Medicare premiums, and Social Security taxation in your later years. We have covered a lot of ground today, including 4 account types, 7 sets of IRS limits, and numerous rules. The overarching principle is tax diversification. Your taxable account provides liquidity. Your 401k match offers a guaranteed return. Your traditional IRA gives you investment freedom, and your Roth IRA provides tax-free flexibility. The optimal approach for most investors is sequential. First, contribute enough to your 401k to capture the full employer match. Second, max out your Roth IRA if you are eligible. Third, return to your 401k or taxable brokerage for any remaining savings. Your future self will not remember the specific funds you chose in 2026, but you will certainly feel the difference between a taxable, tax-deferred, and tax-free dollar. Now that you have a solid understanding of where to hold your investments, the next logical question is what to put inside those accounts. In the next episode, we will dive into the world of financial products. We are going to cover stocks, bonds, ETFs, options, futures, and contracts for difference. We will look at the full menu of available products, discuss when each of them makes sense to use, and help you determine which of these products match your personal risk profile and investment goals. This will complete the foundational half of our season, preparing you to transition from a beginner to a confident, informed investor. I will see you in episode 4.